The U.S. markets are currently closed for the weekend. As of the market close on Friday, October 17, 2025, shares of Crispr Therapeutics AG, ticker CRSP, finished the session at $69.15. This represented a modest gain for the day, up 72 cents or just over 1.05%. The stock traded within a defined range on Friday, hitting a low of $67 and a high of $69.57 on volume of just over 2 million shares. Now, many investors might see that simple 1% gain, close their Robinhood app, and think it was a quiet end to the week. This is the expectation. The reality, however, is far more complex and tells a much more dramatic story. The most significant development for Crispr Therapeutics didn't happen during Friday's trading session. It was quietly filed with the SEC just 2 days prior, on Wednesday, October 15th. The company filed an 8-K announcing a new open market sale agreement. In plain English, this is an at-the-market, or ATM, offering. Crispr has given itself the authority to sell, at its discretion, up to $600 million in additional common shares. This is the information that separates casual observation from serious analysis. The stock's modest float on Friday was simply the market digesting this new, very large, potential supply of stock. This isn't a signal of distress. In fact, a look at their balance sheet shows a robust cash position. But it is a signal of intent. The company is securing its financial resources for the long haul, and it's choosing to do it now while the stock is trading near $70, rather than when it was languishing near its 52-week low of $30.03. This is a strategic move that institutional holders on platforms like Interactive Brokers would analyze deeply, while a retail investor focused on self-investing might completely miss the filing. The general market belief, the narrative you hear, is that Crispr Therapeutics is the future. It's the company that harnessed the Nobel Prize-winning gene editing technology and got the first ever CRISPR-based therapy, Casgevy, approved for sickle cell disease and transfusion-dependent beta thalassemia. This approval, which began rolling out in late 2023 and 2024, was supposed to be the starting gun for a new class of medicine, and by extension, a new, massive stream of revenue. The expectation is that this is a story like the early days of NVIDIA stock, where a foundational technology begins its unstoppable commercial ascent. The reality, as always, is a much tougher, slower, and more complicated grind. The stock's recent chart shows this tension perfectly. This isn't a smooth climb. Looking back just a week to October 10th, the stock closed at $73.07. On Monday the 13th, it had plunged over 6.5% to $68.29 on heavy volume of 3.19 million shares. Then it spiked to $71.82 on the 15th, the same day the $600 million offering was filed, only to fall 4.7% the next day to $68.43. Friday's small gain to $69.15 is just the latest step in a very volatile dance. This is not a set-it-and-forget-it asset right now. It's a battleground. A significant part of this battle centers on that lead drug, Casgevy. The commercial launch is underway and the progress is steady, but it's not the explosive ramp-up some had hoped for. The Q1 2025 financial results, reported back in May, gave us the first real numbers. The company noted that over 65 authorized treatment centers, or ATCs, had been activated globally, with more than 90 patients having had their cells collected for the procedure. This is progress, certainly. Reimbursement agreements have been secured in England, Wales, and Austria. This is all positive. But the financial reality is that this is an incredibly expensive and complex therapy. The process is ex vivo, meaning a patient's cells are removed, edited in a lab, and then reinfused. It's a significant undertaking. And financially, we have to remember the partnership with Vertex Pharmaceuticals. Vertex leads the global development, manufacturing, and commercialization. In return, they split the program costs and profits 60-40. Crispr Therapeutics only sees 40% of the profits from its own groundbreaking therapy. This is a detail often lost on those just starting with online investing who see the headline "CRISPR drug approved" and assume 100% of the upside. The Q1 report showed a net loss of $136 million. This company is still very much in its high-spend phase, which brings us back to that $600 million ATM offering. They are funding the next wave. This is the core of the long-term thesis, the one that Fidelity Wealth Management or Schwab Intelligent Portfolios might build into a high-growth, high-risk allocation. The true long-term expectation for CRISPR isn't just Casgevy. It's the platform. Casgevy is the proof of concept. The real prize is in-vivo editing, the ability to edit genes directly inside the human body. And here, the pipeline is showing significant promise. The company has highlighted positive top-line data from its Phase 1 trial of CTX310, which targets ANGPTL3 for cardiovascular disease. The data was impressive, showing dose-dependent decreases in triglycerides of up to 82%. They are also advancing CTX320, which targets LPA, another major genetic risk factor for cardiovascular disease. These are not rare diseases. These are conditions that affect tens of millions of people. This is the multi-billion-dollar opportunity that makes the current losses acceptable to long-term bulls. Beyond that, they have CTX340 for refractory hypertension, and just presented new preclinical data on CTX460 for alpha-1 antitrypsin deficiency on October 10th. This is where the future valuation is being built, in these quiet, early-stage programs that require hundreds of millions in R&D capital. The capital the company is now securing. Then there is the other side of the pipeline, immuno-oncology and autoimmune diseases. CRISPR is developing allogeneic or off-the-shelf CAR T therapies, CTX112 and CTX131. The expectation here is to create a cell therapy that doesn't require using the patient's own cells, making it faster and cheaper to deploy. Updates on these programs are expected in 2025, and they represent another massive, albeit highly competitive, potential market. This is the blue sky scenario. The company is effectively fighting a war on three fronts: commercializing its ex vivo hemoglobinopathy drug, Casgevy, developing its in vivo cardiovascular and rare disease platform, and building an allogeneic CAR T oncology business. This is an ambitious, capital-intensive strategy. It's a strategy that almost requires an investment of this scale. So, how do you value a company like this? It's incredibly difficult. This is not like looking at Apple stock with its predictable iPhone sales and services revenue. This is a binary bet on scientific success and regulatory approval, years down the line. Analysts are overwhelmingly positive, but their targets are all over the map. According to recent data, of 13 analysts covering the stock, nearly 77% rated a buy or strong buy, with the remaining 23% at a hold. There are virtually no sell ratings. The expectation is clearly positive. Morningstar, for example, recently reiterated a $106 fair value estimate, suggesting the stock is significantly undervalued at its current $69.15. But here is the reality check, buried right in that same analysis. They assign a very high uncertainty rating. They don't project the company to reach positive net income until 2029. That is a long time to wait, a long time to weather volatility, and a long time for competitors to catch up. This is why the disconnect between the daily chart watchers and the long-term holders is so vast. If you are trying to trade this stock on a platform like SoFi Invest or looking at the daily swings, the 600 million ATM offering might look scary, like dilution that will weigh on the price. You'd be focused on the fact the stock is 12% off its 52-week high of $78.88. But if you are a long-term believer, you see that $1.85 billion in cash they had at the end of Q1, add another $600 million in potential financing, and you see a company with a fortress balance sheet, fully funded to get its in vivo programs through critical Phase 2 and Phase 3 trials. You see the $106 price target and believe the $69 is a discount. This is the central tension of Crispr Therapeutics stock. Comment below with what you think is the real long-term value: Casgevy, the in vivo cardiovascular pipeline, or the oncology drugs. Looking ahead, the path for CRSP remains tied to data. The next major catalysts will be updates on the in vivo programs, CTX